2024 marked a second consecutive year of industry-wide contraction and underperformance, driven by an unlikely accumulation of negative forces. Entering the year, the crop protection industry stood at a crossroads. Restructuring was underway, with a shared emphasis on focus, and companies expected a long-awaited turnaround. 2024 was expected to be the start of a new normal. Following a difficult 2023, companies set ambitious sales targets. But as the year unfolded, it delivered a stark reality check. Channel destocking persisted longer than expected, worsened by unfavorable weather, resulting in dampened demand. Chinese overcapacity in AI production, driven by a structural imbalance, continued to weigh heavily on prices, while aggressive expansion of Indian and Chinese generics into key overseas markets further intensified competitive dynamics. Farmers, pressured by declining crop prices and increasing interest rates, adopted a just-in-time purchasing behavior, driving intense price sensitivity and demand volatility. In Brazil, inflation and market pressure driven fragility in the distribution channel, with bankruptcies challenging go-to-market strategies. By mid-year, it was clear this wasn't a long downturn. This is the new normal. In this new normal, the only constant is change. Challenges and opportunities surface quickly, and competition is fiercer than ever. Every company in the industry embarked on a transformation journey. Corteva completed 3 years of strategic refocusing of its markets and portfolio, including the sale of its solo Mancozeb business to UPL. Its productivity gains and focus on portfolio differentiation helped cushion the blow in 2024. Corteva's merger heritage sustained a strong pipeline and a highly differentiated portfolio. As a result of differentiation and early transformation, Corteva ended the year with comparably minimal sales decline and a stable EBITDA margin. FMC began transformation this year with ambitious targets to regain investors' trust after a difficult 2023. As challenges mounted and growth stalled, investor confidence weakened, and the company's stock came under pressure, reflecting growing concerns over performance and strategic direction. In response, FMC intensified efforts, divesting its non-crop business to reduce debt and refocus on efficiencies in its crop solutions. These moves helped to maintain the highest EBITDA margin in the industry, despite pricing pressure. Meanwhile, Rynaxypyr, one of FMC's key revenue drivers, faced increasing generic competition, leading to price erosion and volume pressure. The company is now taking aggressive actions to enhance its differentiated portfolio, including new market strategies for key molecules and investment in alternative LATAM sales channels. BASF, the last Western chemical giant, remained under scrutiny for continued underperformance in its agricultural solutions unit, which has limited synergies with the rest of the business. After announcing the legal separation of its ag business in 2023, with dedicated KPIs and increased autonomy, the company confirmed a 2027 spin-off timeline and began exploring IPO options. The transformation forced bold moves, such as ceasing production of its legacy herbicide glufosinate in Germany, switching to buy to improve cost position. A shift forced by falling active ingredient prices due to China overcapacity. In parallel, BASF defined a country focus aligned with its strategic goals, including operational and investment shifts. In Brazil, it secured funds through a credit rights investment fund to improve its financial support to distributors and farmers and manage credit risks effectively. Despite those significant moves, BASF ended 2024 with another major EBITDA decline. Bayer continued to struggle in 2024, weighed down by debt and earnings decline. Crop Science underperformed, dragged by ongoing glyphosate litigation and regulatory challenges. Its dynamic shared ownership model, a decentralized structure empowering small, accountable teams to accelerate innovation and reduce internal complexity, made progress. Headcount was reduced, and cost savings were achieved. As part of this focus, Bayer announces its glyphosate operations would run as a separately managed business. UPL, once defined by its strong cost advantage, struggled to maintain it amid Chinese overcapacity. Still reeling from a difficult 2023 and downgraded by all major credit agencies, UPL focused on productivity gains and debt reduction, leading to the partial divestment of its seed business, Advanta. While navigating financial pressure, UPL sought growth, particularly in Brazil's direct sales segment. Through its joint venture, Origio, it expanded into farm financing to offer integrated solution. Our Syngenta Group continued its focus on operational and financial transformation to improve margins and cash flow. Syngenta Crop Protection focused on successful ramp-up of its innovative actives. ADAMA stood out on EBITDA improvement, focusing on the value innovation segment, exiting selected countries and underperforming products. Though sales declined, its transformation, driving hundreds of improvement initiatives, drove market-leading EBITDA and EBITDA margin expansion and strong cash flow generation. As the dust settles on 2024 and the ag industry's new norm, the search for sources of differentiation is driving the agenda, with hopes it will fuel the next wave of growth. While traditionally led by new active ingredients, differentiation is now increasingly rooted in value innovation, delivering novel customer value through product design and commercial innovation, allowing a more accessible return on investment. Some companies are refining their crop protection offer, while others are testing the waters in biologicals, digital tools, and regenerative agriculture. The industry is chasing its next edge, shaping more complete offers that meet the full spectrum of farmers' needs. One thing is certain: the playbook is being rewritten.